Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Well, welcome to a new episode of Canadian Investing in the U.S. With host Glenn Sutherland. This week, my guest is a returning guest, Brandon Cobb. So we had him back on the podcast 2 years ago, episode 202. So if you like this, you can go back and check out the other ones as well. Brandon, let's for people who it's been a couple years, give people a bit of an intro to yourself, what you do, and we'll go from there.
Yeah, so I'll kind of reverse engineer it here. And again, it's a pleasure seeing you again. It's been a while. It's funny.
Thanks.
I think the last show we were on was like pre-interest rate hike. I think it was like Q1 of 2022. So there's been a lot that's changed.
Yeah.
So there's a lot to talk about. I'm excited to jump in with you today. But I'm one of the co-founders of HBG Capital. We're a real estate investment firm that primarily focuses on real estate assets in the Nashville, Tennessee market, with a concentration in first-time homebuyer housing. So everyone talks about how there's this affordable housing crisis. You've got 33% of the millennial population chasing 10% of the homes that are being built. So there's some pretty big supply and demand imbalances there. Yep. We're trying to go after that niche. And so we do that by aligning ourselves with the local municipality's vision. In other words, where are the parcels of land that are not the highest and best use? And how can we add value to the city by rezoning those to higher density? In other words, force appreciating the value of those lands to put more of those first-time homebuyer communities on the ground. But once upon a time, I did medical device sales. So I was a young guy in his 20s, wearing scrubs, rubbing shoulders with orthopedic surgeons, training hospital staff on how to use my product. Loved what I did for a living. No entrepreneur tendencies. No sob story about how I hated my corporate job. I was happy. Medical device sales was my dream job. I didn't want to do anything else until one Friday afternoon after I had a fantastic day in the field. Other competitor rep picked the surgeon off, had a successful trial. He invites me in to look at using more product. And I mean, best day you could have as a sales rep.
Yeah.
And I walk into Starbucks 5:00 one Friday, sunny afternoon, where you can just smell the coffee in June, where like the summer is knocking on spring's door. My boss fires me. And that was a complete shock to the system. I was like, what did I do wrong? I read all the books. I worked as hard as I could, put in the sweat equity, and I got fired. And so that day taught me a valuable lesson that I carry with me to this day, and that is nobody's going to look out for your financial well-being but you. And so now I'm on a journey to help more people who are in a working profession, more business owners, reach financial freedom through real estate investing.
I love it. So, like we talked about, haven't talked to you in like 2 years. So, you were doing a lot of different things in real estate. And how has things changed in the last 2 years? Is there certain things that are working better than other things? Is there a strategy that you like better? That what is in your business? What's changed?
Man, there's a lot. One are the asset classes that we're focused on, right? I kind of nipped on that a little bit. Like we're very heavily going in on real estate assets where there's big supply demand imbalances. So entry-level housing is one of the products that we were building back pre, 2002 interest rate hike. Didn't make up the entire portfolio. Now it does. And so we've become a lot more crucial on our underwriting and like what we're focused on. We've got 6 main strategies that we're now implementing. Some of those strategies we did not do before. And those 6 are, number 1, got to have multiple exit strategies lined up. Number 2, you've got to be able to control the debt. 3, you've got to have the ability to hold that asset through whatever crazy market environment gets thrown at you. 4, you've got to be able to force appreciate the value of that asset. Number 5, you preferably have to have an end buyer contracted and lined up. In other words, your exit taken care of. And number 6, we're really heavily focused on downside protection. How much ability does that asset have to be able to fall in value before you break even? Those are the 6 we're really focused on, and happy to jump into any of those 6 more if you want.
Yeah, I didn't write that down, so we kind of flew through those a little quickly. So I think let's go into those a little bit more. So what was the first one again?
So multiple exit strategies and how we're really
that all the time. I preach the same stuff.
And it's easier said than done. So I wanted to give some teeth here with it today. So what does that look like exactly? So whatever you're in, you want to have multiple exit strategies. And so I'll kind of talk about how we're utilizing it, and we can kind of ping pong it back and forth. So for us, everything starts with one being in a good asset class where there's multiple supply and demand imbalances, because you can have multiple exit strategies lined up, but if there's not a market for it, then I'm sorry, it's not going to work. So
Right.
for us, it starts with working with the local municipalities and identifying the vision that they want to create for the community. I want to be on the same side of the table as the city, not the opposite side trying to force something down their throat. So we start with them and we look at the parcels of land in the community that are not the highest and best use. In other words, where they will support a rezone, or where they will support our value add strategy. And then we go after those parcels of land, and then we force appreciate them by taking them from putting, 1, 2, or 3 homes on them to putting 100, 200 homes on them. That builds in the safety net for ourselves and our investors. And by the way, we do this before we ever buy it. We contract with an outcome contingent. And once that outcome is reached, in other words, we force appreciated it, then the value is there. So what do the multiple exit strategies look like? From that point, after we've force appreciated the value of the land, we can then sell that land to another developer. Right. Exit strategy number one. We can be the developer where we develop the land and sell it to a builder or somebody that wants to go vertical on these communities or this commercial property or whatever. So we're the developer on it. Exit strategy number two, we do that with investors. Exit strategy number three is we develop it, hire a builder that then goes vertical on it, and we can sell that vertical product to the end consumer or a build to rent fund or whoever. And then exit strategy number four, and this is really one we have not done yet. It's new. Again, this is really focused on, the third thing that I told you here, the ability to hold. We're trying to figure out how to do build to rent communities. We want to be able to hold these assets long term. So for us, that's 4 different exit strategies that we've got starting from the very beginning that we can fall back on in the event that 1, 2, or 3 doesn't work out for whatever reason.
Yeah, and you're talking about rezoning. This might be your secret sauce, and I understand if you can't share this, but what are these typically starting with? Are they starting with like a large lots of residential? Are you talking about a commercial lot that you're turning into a residential lot, or what's the conversion that you're usually trying to rezone?
All the above. Doesn't matter. Whatever it is, we want to look for the highest and best use of that land. And here's a little secret. Just because the city says that they want a particular thing doesn't mean that's going to be what the market wants. So very, very important that if you're just starting to do this, or if you've been in the game, because the city says, I want this thing there, doesn't necessarily mean that you should put it there. I'll give you an example. We had a piece of land that was great mixed use right smack dab in the middle of the city. Beautiful parcel of land. City goes, we want to put a grocery store here, and we want to put apartments above it. And, we kind of wanted the townhomes around it. So like, hey, we'll give you the 50 townhomes. We want a grocery store here, and we want apartments above it. Well, we went through this whole process of getting everything approved, trying to line up an end buyer for, these assets again, because that's exit strategy that you need. Number 5 right here is you want to have an end buyer lined up. Not feasible. Not good. What actually needed to be there was a medical office building and a retail strip. Took us the better part of 8-9 months to realize that, because at the time, all we wanted to do was just give the city what they want, be a valuable asset, let them know, but it's got to make sense for us. And so making sure that you communicate, figuring out what the market really wants, and then explaining that to the city and working with them to give them what they want. That's the key. So these parcels of land can be commercial, they can be residential, they can be industrial. It's identifying what the highest and best use is and what the market wants.
Love it. Love it. All right. Number 2.
Number 2 is you got to be able to control the debt. We changed where we were going and doing these land developments. We were bringing 50% investor equity to the table and then 50% debt. And we were contracting with a builder who would give us a 10% down payment. In other words, like, for example, I've got a deal right now where we're developing 74 lots for a builder. Yep. And they're giving us like a 10% down payment. So we're selling these lots, I think, for close to $7 million. I've got a $700,000 check in my account. They've got skin in the game. I've got an end buyer lined up for this. It is 100% investor equity. There's no debt on this deal. It's all investor capital in this, which means we control it. There's no bank that can call the note due, call the debt due. So that's very important. We're buying these land and doing these horizontal developments with 100% investor equity. So that allows us to stomach and weather whatever interest rate storm gets thrown our way or whatever market gets thrown our way. So very, very important that you have the ability to control if you are using some kind of debt or you're at a stage that your in buyer is very small pool of buyers that can buy that land, right? Those finished lots. And so we want to make sure that we've got the ability to sit on that for a long time as needed.
Okay. I'm going to try to word this question correctly, but a lot of people usually go the opposite way, is what I usually hear, is they want to try and get as high of leverage from the bank and put in as small amount of investor capital. I guess it all depends on how you pay your investor capital for this to make sense. Do they get paid like a monthly rate right from the start, or is it once the lots are sold, or how does that make sense? I'm just trying to sort this out in my brain, because a lot of people are going to go, I'd rather have all the debt from the bank. Hello, everybody. Thanks for listening to the podcast. I just wanted to let you know that I've created a new coaching program. I believe the new coaching program has way more value than any of the programs that have even existed in the past. What we've done is pre-recorded all the lessons so that you can work through it at your own pace, which is pretty cool. And then we're going to meet up on a regular basis to answer the questions, do deal analysis, and actually spend our time together working on things instead of spending our time learning things. I think this will make a seamless transition to buying in the United States and will help you solve a lot of your problems. If this is of interest to you, go to glensutherland.com/coaching. I hope to help you guys invest in the United States, and I hope we provide as much value as possible. Back to the podcast.
Yeah, no, 100%. And so it definitely depends on where you're at in the market cycle and what your investing strategy is and your risk tolerance. Risk tolerance. Let's talk about that. Our number one goal is not return on capital. There's plenty of people that are going to pay you a lot more for your money.
Yeah.
Our focus is on capital preservation. So there's three main things I tell investors they really need to focus on. One is capital preservation. Mm-hmm. One is return of capital. And then three is return on capital. Because capital preservation, if you send something and it goes to zero, like an individual stock, you're in Blockbuster, Netflix comes along, goes to zero, you're screwed. That's capital preservation. Two is your return of capital. If you've got it locked up in something where you're never going to see it again, it's there, but it's not liquid for 20 years. Well, then, that's a problem. So return of capital is number two, and then return on capital, right? Obviously, if it's in a bank earning 0.001%, not a very good return on capital. So those are the three, but the first and the foundation is capital preservation. We want to focus on that first. What does the waterfall look like? We don't have a cash flow event like multifamily or something does. We don't have monthly rents coming in. So we structure it where once the lot starts selling or the land sells or the homes start selling, 100% of those go to the investors until we have paid them their pref and their original principal back. So we literally can't make money as managers until the investors have their capital back and they have their returns that we said that they could have. So that's how we currently have things structured. And you're right. There's nothing wrong with leveraging and getting a lot of bank debt. But for us and our individual strategy that we use, it doesn't align with long-term capital preservation in this current interest rate environment.
And no, it does make sense too, right? I can see both sides of this, and I know a lot of people who are doing syndicating deals and funds, and they can get into trouble with the bridge debt, especially right now if they didn't buy rate caps. There's it is a safer play. It makes sense, right? And they're still going to get their money out as a pref, right? They're just going to get it when there's money to be the best time if you're an operator to pay people is when money comes in. Not paying people back with money that you've raised, because honestly, it doesn't make any sense. We're just going to raise more money to pay people. It's not, you should be paying when there's money coming in, right? That makes sense.
I've never understood that model where you're having to raise money from the people that you're raising from, and you have to raise extra to pay them back that on a monthly or quarterly draw, whatever. That just doesn't make any sense. That just means the asset's not performing right, or you haven't set your cash flow up right. Now, if you're using a structure where you are introducing some bank debt, you definitely want to raise some money in an interest escrow account to be able to pay that bank debt for longer than what you think the life cycle of that deal is going to be. And, we do that when we're going vertical on our houses.
Yeah.
But our goal is like, how do we reduce that monthly overhead as low as humanly possible? And, the biggest cost of, real estate are like those monthly interest payments and your overhead.
Yep. Totally agree. Yep. What are we up to? Number 3 or number 4? I think number 3. I don't know.
Yeah, let's see. Number 3 is the ability to hold. And so we kind of talked about that and touched based on this. Number 2 was controlling the debt. That falls into number 3 is you need to be able to hold these things. If you're in multifamily, you want to make sure it's cash flowing, right? Rents are greater than your interest you're paying, your mortgage, and all of your other expenses every single month. Land, we bought a piece of land literally in September 2022, the worst possible time you could buy it, but we bought it with investor equity, and we could sit while the market stayed frozen for over a year and just sit and hold on to it. We could hold it. Had we bought that with bank debt on a 12 month loan or whatever, the bank would have been like, hey, where's our money, guys? And we would have just sat and ate interest for an entire year. So you've got to have the ability to hold that asset long term.
Yep. No, that makes sense, because that's even goes right back to your step 1, right? Having multiple exits. You're not being forced to flip the land or flip the houses once you built the houses on the land. You can hold this as well. Yeah. Okay.
Yeah. 100%. And then number 4 is forced asset appreciation. You don't want to buy something, you make your money going in, right?
Right.
That can be hard when you're out there trying to find deals, because everything out there seems to be retail value. So you got to get creative. You got to figure out, how can I force appreciate the value of that property to add value to all parties involved? What I love about development is there's so many people that win. Here's how we're force appreciating our asset values while reducing risk. When you go into a multifamily property, for example, you're usually purchasing it kind of as is value, and then you're increasing the value through a value add strategy. You're renovating the units, you're increasing the rent, you're stabilizing it, and that occurs, that then force appreciates the value. What we do is we go in and we might take a parcel of land. Let's say it has a house on it and it's sitting on 20 acres, whatever. It's got access to sewer. And we say, hey, Mr. Homeowner, your home's worth about $450,000. If I could offer you $800,000 for it, would you be interested? Well, all of a sudden, they're like, yeah, I mean, how are you going to do that? And we explain, in your property, I'd like to put 80 homes on this piece of land, and I will go under contract with you. I'll give you earnest money. I'll pay for all the civil engineering that needs to be done to design it. And once we get the approvals with the city, I will close and give you your money. And they're like, well, heck yeah. How long is that going to take? About a year and a half. Cool. Sign me up, because they know they're never going to get that kind of deal from a consumer. So there's a very, very compelling value proposition that we offer to our sellers. So they win. They win because we're able to offer them a lot more, and we force appreciate the value of that property by taking it from 1 home to 80 homes. All of a sudden, it's worth a whole lot more money. And that's how we're using the forced appreciation method.
Yeah, and you're playing it safe at the same time by, you're gonna have the contingencies that if they can't get this rezoned, then he's welcome to go sell it on the the MLS and get what the value of the actual property is.
Yep. There's no risk on the homeowner's end. Literally no risk. We're taking care of everything. Yeah. And then number 5 is having your exit strategy lined up. So while we're taking a year and a half to get this piece of land ready, we've got so many different parcels. It's a fluid environment. Right now, we've got over 600 units that are currently in the pipeline. I'm not going to build 600 homes this year, right? That's why we've got those 3, hopefully 4 here soon, exit strategies lined up. That first exit strategy and second exit strategy, during that year and a half, we're out there contacting potential buyers like, hey, Mr. Developer, would you like to have this piece of land once it's entitled and ready? Hey, Mr. Builder, if we could develop and sell finished ready pads to you, would you like to buy them? And then we're going, hey, investors, if we had this piece of land, would you like to build some houses with us on it? And so we're finding buyers, and we've got plenty of runway to do this because it takes a year and a half to do it. Plenty of time to find and line up those end buyers for our parcels. And worst case scenario, if we do spend a year and a half getting this piece of land ready and we just can't find an end buyer for it, well, then we've force appreciated the value of the land for the homeowner. Yep. We've added value to them. And then if we can't perform on it, whatever reason, they get earnest money, they get all of our work that we've done. And so it's a win no matter what happens in this scenario.
I like it. And I like lining up the end before you start, right? Like I've been doing a lot of social media marketing courses, and that's a lot of it is sorting that out ahead of time, right? Not doing big leaps of stuff that you don't know is going to pay off. It's making sure the end is going to be worth it. How does that saying go? The squeeze is worth the anyway, it doesn't matter.
No, I know where you're going with that. I've heard that saying too, and I can't. It's not coming to my mind either right now.
Anyway, somebody who's listening to this can put it in the comments because it's not right there for us right now. But no, it makes a lot of sense. Like then you're making a whole project, and you're not. Like with a lot of people, even myself, in one of my business, it's you don't have that exit. I renovate a property and then I'm hoping that it sells based on what other people have sold in the past.
Yeah. And what I love about it is we're getting a deposit from the end buyer. It's kind of like if you're selling your house and you're like, okay, we're getting ready to sell our house a year from now. All right. Not today, but a year from now. And you kind of lined up who your buyer is going to be. And that buyer gives you a 10% deposit. So if you're selling your home, Glenn, for $500,000 and you're going to do it next year, how nice would it be to have that end buyer give you $50,000 today to reserve that sell a year later? That's basically what we're doing here.
Yep. No, I love it. Cool. Number 6, I think we're up to.
Yeah, I think we're on number 6. Then this is downside protection. Everybody kind of knows this one, but what does that look like exactly? So, typically on our land deals, I'll give you an example of one right now that we're doing. So you force appreciate the value of the asset. That's great. You're creating a value. You're creating a safety moat for you. You're creating a safety moat for your investors' capital. How much now would the value of that asset have to decline before you break even? And this is the number one thing I don't see investors ask. And when I'm doing one-on-one investor calls with people who book calls with us, and they ask me, I love this question, Brandon, what is something that I haven't asked you that I should be asking you? The first thing I say is, you should be asking me and anybody else you're meeting with, how much does the value of this home, how much the value of these lots, or how much the value of this land has to decline before I break even on my investment? And what would it have to decline to before I actually see a loss? Nobody ever asks this question. And it's something that is extremely important to understand as an investor. We had a deal where, we're doing 74 lots right now for a builder. We're going to be selling that for close to $7 million. I want to say it's like 6.7, 6.8, I think is what the end value of the lots are going to be worth after we put the roads and infrastructure in. We've got a deposit in place. My total cost on that project is right around $4.8, $4.9 million. So if you look, I know I'm selling the lots between $83,500 per lot all the way up to $86,500. And so I know that if you were to take those 74 lots and divide it by, divide 4.8 million, my cost, divide those 74 lots, that's a pretty big runway. I know I'm going to shoot from the hip here, but for those listening that have a calculator, you'd have to see the value of those lots drop somewhere around $83,500 a lot. I want to say down to in the 60,000. 6 times 7 is 42. Yeah, so somewhere in like the mid 60s. So you'd have to see from an 83,000 lot price down to call it like a $63,000 lot price. That's a $20,000 drop per lot. That's equivalent to about a 25% reduction in value. So that's a very, very long runway. And by the way, that's just to break even and get your money back. So you've got a pretty good runway there for the asset to decline in value to protect the investor's capital.
Yep. And I think that's something everyone should be looking at with anything, no matter what strategy you're looking at doing. You're looking at doing a project yourself. you're looking at doing investing in someone else's project, where do we start getting ourselves into trouble?
Yep, 100%.
Sorry about that. So Brandon, what else should I have asked you? That's I always love that question. I always love to ask that right at the end.
What else should you have asked me? One of the things we paid a lot of close attention to, especially after the interest rate hike, is where is the money moving to? Because COVID revealed this environment that everybody sort of knew was there, but no one really paid a lot of attention to it. But COVID made it very evident, which is you've got business friendly states and you've got non-business friendly states. So you've got a huge influx of capital that is moving away from non-business friendly states, people who shut down economies during COVID, New York, California, to these business friendly states that kept things open. Florida, Texas, Tennessee. So pay attention to where the money is going. And for those that want to pay attention to where the money is going, there's four main types of money that you've got. You got institutions, you got large corporations, you got small businesses, and you've got consumers. And a quick little tip on how to look and see where that money is going. If you're trying to identify if institutional money is moving into a market, go and look at the skyline before and after. See if you can find pictures online of what the skyline looks like before and what it looks like after. Nashville, for example, go type in Nashville skyline before and after. You'll literally see like double the amount of skyscrapers downtown. It's really, really cool. It's a great way to see whether or not institutional money is coming into a market. Another great way to identify that is go count the cranes. If you can go and get on a hill and look at downtown or drive downtown, count the number of cranes that are going up. You can also look at how many new hotels are coming to an area, because that's a big identifier of institutional money coming to a specific spot. Nashville, for example, we've got 33 hotels that are slated to open in the next 3 years. Crazy. We've got some of the highest hotel rates in the country because of that supply and demand imbalance. So those are several ways to identify if institutional money is moving. As far as large corporations, the second type of money, you want to look at, again, how many downtown buildings are going up with like a name on it. So, for example, Nashville, we've got a new building downtown, the Amazon building. It's going to have 5,000 C-suite execs. I know that Amazon is moving here. Yeah. Oracle, Alliance Bernstein, Facebook data centers in Gallatin. It's a great way to identify what's coming. Grab a copy of your local business journal. We've got the Nashville Business Journal. I'm sure there's the Dallas Business Journal, the Toronto Business Journal, and read it and see what they're saying about the large corporations moving here. So that's the second type of money. And then the third is small businesses. Look at what the commercial leases are doing, right? Are they going up in value? What does the commercial look like for small businesses? That's a great way to identify whether small businesses are moving into a particular area. And then for consumers, that's the fourth type of money that you want to follow, and you want to make sure that you're in that with them, is what are home prices doing? What is the city's airport doing? That airport, if they're doing a big renovation, that is a huge indication of what's happening with the local economy and how many people are moving there. Nashville, for example, we've got like we just finished $1 billion renovation, and I think they've got like a $3 billion renovation that's set to expand the airport. We are booming, man. So that's a great indication of consumers' money flowing into an area, is what the airport's doing. And then lastly, affordability, not just in the downtown core, but like in the suburbs, because that's where a lot of the demand pushed after COVID. No one, I'm going to say nobody, but a large people don't need to travel downtown anymore. So that push to the suburbs, man, it lit everything on fire. But what is the affordability? Because people are naturally going to go and live in the areas that they can afford. So I say if your money is in areas, specific areas, not just asset classes, but areas, cities, neighborhoods that have this insulation, and by insulation, I mean, is money flowing into it via these four methods I just talked about: institutions, large corporations, small businesses, and consumers, you can bet that your hard-earned capital is going to have a layer of protection that others don't, quite frankly.
I love it. I like it. And I like Nashville. I haven't been there I think it was probably before COVID. So pre-COVID, but I've been there a few times, and I think we're planning on going back again in the fall. It's a fun place.
Put your cowboy boots on. We'll take you honky tonkin', man.
Yeah. Well, Brandon, thanks for coming on the show. You want to, before we let you go, you want to give some information on how to find your company?
Yeah, if you're if you're a business owner and you're an investor and you're looking to build a legacy, if you're trying to retire and more importantly make an impact in your community, go to our website, hbgcapital.net. That's pronounced Harry Bob Gary Capital.net. On that website, there's a ton of free educational resources. I wrote a book called 100 Questions Business Owners Ask Before Investing. I wrote that book because I got a call one day from one of our investors. He said, Brandon, one of my friends has lost all of their real estate investment with a sponsor. Can you talk to him and see what his options are? And it became very clear on that phone call that this guy was out of luck because he was so green to it. 100% investment loss. He could take the guy to court, but he probably still wasn't going to get any money. And he lost his money because he did not know what questions to ask to vet whether or not this was a good investment opportunity. So I said, how can I prevent this from happening to somebody else? And so I wrote that book, 100 Questions Business Owners Ask Before Investing, to give people the tools they need to make a more informed investment decision. Questions are the key to unlock the answers we need to make well-informed decisions that protect our capital. So you can go to our website, hbgcapital.net. You can grab that along with other educational stuff we got. If you're a podcast person, we've got a podcast, Recession Resistant Real Estate Radio. We got to get you on that show, Glenn.
Yeah, we'll set it up. Well, Brandon, thank you for coming on the show. I really appreciate it. This was a good one.
Yeah, man, this has been a lot of fun. It's always a pleasure seeing you.
No, thank you.
That was a nice video. Bye.